have a very bullish outlook long run for silver, and it's worth reminding everybody what they're playing for. So some people watching me here, they might think, not interested in your Korean one trade and your crash AI story. I'm a metals guy, and yeah, so you dissed Bitcoin and all of this, but what, when's my stuff coming good? You're a silverhead, for example. Longer run, I am super excited about what will be coming here. We've called 333 on this, and we repeat it. I don't sell off physical silver ever. We're calling for single-digit gold-silver ratio. So that was, wow, liquidity sell. It had to happen, and that was a flush out of leverage. So we are in the channel on a bit of a glide down. At any point that we set up and we break this, I'll be looking to get back long. So that means a little bit of underperformance from silver as well. Cash price, good luck trying to get the physical stuff for the cash price. And if this whole flag triggered and broke, you could go up if it met its target to the 80.
What is your then perhaps shorter term outlook for gold? You mentioned you think this bottoming process might be over soon.
Yeah, let's cover that. Let's have a look at the gold chart then and give you an answer on the precious metals. After all, that is the nature of your channel. And I do want to say it has been correcting less violently since its first and second correction. We warned that there's likely to be 3 stages to the correction. Before we drop down into the lower time frames, just a small, my apologies, let me just get that out the way. Just a small reminder of what gold does and how it performs over the ages. 1967, these periods, the sideways periods get lesser. This was the financial repression era, and then those eras got far shorter and less able to sustain, and eventually we had that, which was the breakout at 2000. We did get on the big time frame for the 3-monther, that is a bit of a shooting star. It's a green candle one, but there was clearly a long knockback. So, there was a stun to the system. We did a lot in a short time. So at technical candle analysis, that's lengthy wick to the upside is a little bit of what we would call an evening star. In other words, it's little bit of calm and respite is probably going to be coming in. It's just dropped down to the lower time frames because you were asking about the short time frame, but let's work you down. The one thing we also warn people is that there's typically 3 waves of selling for us usually. That's quite a busy chart.
A market can look like it's stabilizing while the real damage is still unfolding beneath the surface. As Francis Hunt points out here, the gold rally isn't clean strength, it's a corrective structure shaped by repeated liquidity shocks and 3-wave selling behavior. He notes how each bounce is met with heavier, more deliberate distribution rather than fresh accumulation. That matters because it suggests institutions are not chasing strength but using it to exit. For investors, this means rallies may feel safe while positioning quietly shifts against them. Next, Francis Hunt exposes how this calm phase often precedes the most misleading breakdowns.
Let me just choose another one which has a few less annotations on it. It's a little neater by a draw that I've done. You're in a continuation pattern for us on the macro, but that doesn't do anything for you now until you break materially above this red line that I'm drawing here. That is our capping descending grind line that's of a channel. I could see you selling off a little more. You are bumping up against this red line. So we spoke about those 3 selling waves. Let me just refer back to that. That was the 5-6 high, almost 5-6, right the way down to the 4-4. So that was, better part of $1,200 there. That was your first harsh sell. Everybody was programmed to buy the dip on gold, so everybody came roaring back in. So we had, disbelief initially. So we went the whole way of disbelief, got up to 5-4, which was only around $200 off, and then you got bang, almost a bigger sell here that took you to 4,098. So that was a very violent one. That was okay. The dip buyers got rinsed as well. That says this is a proper rest that you're having. It's not just a nap under a tree. You're taking a proper rest. That said, it did rally reasonably well, got back approaching 5, and then is in a third wave of selling. So we talk about 3 waves of selling. You had the first, you had the second, and you're getting a third, but it's much more staggered and grinding and sustained and slow, while the others were violent, fast and violent, particularly here, the first one, but you had a very violent candle there as well. It was very hard down.
Markets rarely reverse in a straight line, especially after euphoric positioning builds up across retail. According to Francis Hunt, the gold chart is still locked inside a descending channel defined by repeated rejection at the same structural boundary. He highlights how the first 2 sell waves were violent liquidation events, while the current phase is slower, signaling exhaustion rather than resolution. That difference matters because slow declines often trap late buyers more effectively than crashes. For portfolios, it means patience can feel safe, while capital quietly bleeds into volatility. Next, Francis Hunt reveals how liquidity-driven selling may still have one final washout phase left.
So that was, wow, liquidity, sell. It had to happen, and that was a flush out of leverage. So we are in the channel on a bit of a glide down. At any point that we set up and we break this, I'll be looking to get back long. Could you have, if we were to get the AI event and a lot of bid smashing because of liquidity requirements, could you have a dip to the downside somewhere around these levels at the previous low or even slightly lower? It's possible. It's possible. So you need to watch for that. There's an either way. We're kind of sliding down the hill slowly. We've either got to break the red line and start progressing, and there is also a possibility of an acceleration again if there is the reason to hit it. We have to wait and see. There's no clear pattern for me to hang my hat on too much. This is the third wave of sell. So I want to be hunting for a low, but I have to watch out for that washout low that could happen like that before that. If, however, the market turns and does an impulsive break and starts changing gradient and runs through that red capping descending grind line for that channel, then it may well be ready to start triggering an entry on gold. But right now, I don't think there's anything immediate that we're missing for the trade. And I would say the same a little bit for silver. I was looking at the gold silver ratio. You might ask on this, so I'll just preempt you and go straight to it. The gold silver ratio has an interesting structure on it as well, which I was actually just covering with my community live today, and it's clean that. We see a possible risk that the gold silver ratio is going to have a little squeeze up again. So we also here we're in a bit of a flag.
Liquidity events don't announce themselves. They emerge when leverage quietly exits the system. This is where Francis Hunt's thesis shifts. He emphasizes that the current third wave of selling is driven less by sentiment and more by forced positioning adjustments. That distinction suggests markets are not freely choosing direction, but reacting to structural pressure. He also flags a potential washout low, which typically clears weak hands before any sustainable trend resumes. For investors, that means timing matters more than conviction right now. Next, Francis Hunt exposes how gold and silver ratios may be signaling hidden relative weakness beneath the surface.
And we see the possibility that that could go up. So that means a little bit of underperformance from silver as well. Cash price, good luck trying to get the physical stuff for the cash price, but that could take you to the upside. And if this whole flag triggered and broke, you could go up to if it met its target to the 80. But there's quite a lot of ifs in that. We'll see. There's a small fractal here that we suspect will break to the upside. We'll see if it then triggers the next and the next and the next. So there's a couple of dominoes to fall, and we're assuming each one falls for it to make it a run beyond 80. That would probably, though, be in quite a big risking off environment. Don't forget, I'll also point to Bitcoin. We've been short Bitcoin and Ethereum quite a bit, and it's been paying incredibly well. And the amazing thing to me is it's funny how old hat and no dance anymore Bitcoin is in the environment that they now have SpaceX and Anthropic and the biggest IPOs to participate in. Suddenly we seem to be having a lot of dissipation. And also Mr. Never Sell, Michael Saylor, sell a kidney, never sell your Bitcoin, sold some Bitcoin to make dividend payments on some of the complexities of his leverage structure. So a lot of the almost untouchables, the holy grail statements have all been perverted. It's a bit like virginity, Once you start tinkering it with it, it keeps getting easier. And that's what seems to be happening. The mystique on Bitcoin is certainly not very strong at the moment. And it seems to be facing quite a bit of a brunt of people lightening up on the high beta tech space to get some IPO action. So you could surmise that there may be some substitution there.
When correlations break down, markets stop behaving like stories and start behaving like liquidity rotations. According to Francis Hunt, silver strength is not isolated. It's conditional on a fragile chain of technical triggers that can fail sequentially. He points out that even Bitcoin, once treated as structurally untouchable, is now behaving like a high beta liquidity proxy. That matters because it signals institutions are rotating risk, not committing conviction capital. For investors, this turns bullish narratives into temporary positioning flows, rather than durable trends. Next, Francis Hunt unravels how these cross-asset shifts often precede broader risk-off cascades that retail only sees after the move begins.
Thank you for taking us along there, Francis, for the short-term outlook. What about the longer-term vision that you have for the precious metals complex? Because it sounds like this stagflation thesis that you have is incredibly bullish for hard assets. Where does that leave the long-term thesis, and how do you balance that versus trying to optimize, short-term entry points?
It's a very good question. Trading and trade execution. We're investors, blue pot investors, and those are unchanged. So everything I've been stacking, I continue to stack. So I don't sell off physical silver ever. I'm like the no sell Bitcoin guy on my silver. It's too much of a hassle. It's heavy. All of this. So so I'm a stacker in terms of the blue pot, but we trade a lot and we've made a lot of profits trading, and we've used it to further to build stack. So I always say tax down to your blue pot. That's your unleveraged wealth, which you sit on, and it's physical and it's real. I have a very bullish outlook long run for silver, and it's worth reminding everybody what they're playing for. So some people watching me here, they might think, not interested in your Korean one trade and your crash AI story. I'm a metals guy, and so you dissed Bitcoin and all of this, but when's my stuff coming good? Again, and you're a silverhead, for example. I mean, longer run, I am super excited about what will be coming here. We've called 333 on this, and we repeat it. And we'll tell you we have a real reason for it as well. It's not a number we just chose to try be controversial or anything like that. It comes from our technical setup. This is a falling wedge. I'll just hide some aspects of the chart.
Long-term conviction and short-term trading are rarely aligned, especially in metal cycles driven by volatility compression and sudden repricing. What Francis Hunt is highlighting here is the separation between stacking capital and trading capital, where one is designed for preservation and the other for opportunity. That distinction matters because most retail investors blur the two and end up reacting emotionally to short-term swings. He frames silver as a structural hold while still actively exploiting volatility cycles to grow positions. For portfolios, this means survival depends on discipline, not prediction accuracy. Next, Francis Hunt exposes how long-term targets like 333 are built on structural geometry, not sentiment.
This for us is a falling wedge structure. There you go. That's what you've got. And this is, without doubt, on the long enough time frame, you have to be patient, a continuation pattern. But it's how you let off some steam when you just had a blow off. Don't forget, you're at about 48, and next thing you knew, you were at 121. Hang on a minute, that's quite a few. Remember when silver used to change a couple of cents, 15 and 25 cents a day, and move $1 over 3 or 4 months? Well, your silver went from sub 50 to 121. So it put on $71. $71. I mean, that's insane as a move, and you're wondering why you're having a little bit of a hangover right now. Okay, get over it. 3 waves of selling, 1, 2, and then a grindy week 1, and then we will be going again. And let's remind you why it paused, because we actually had leveraged for a large part of this, and then closed our leverage at the tail end of January. We were very fortunate. We don't always get it perfectly right, but we were. And why was that? Because we have a macro setup. It's a quarterly setup, and it was pointing to we're being at second interim coming up, and our second interim level started at the late 90s and going to the 110. So I'll draw that setup. This is the setup where the 333 comes from. It is given to you on the target, and it is created geometrically from the history all the way back in 1980. So 1 second while so here we go. This is the draw I wanted to give you. There's your 330 plus. It's going to be a tiny bit higher because the data here on the highest point is actually slightly short. We did, in fact, trade 50 back in the 80s on silver.
Parabolic moves always leave behind structural imbalances that take time to digest before the next leg begins. According to Francis Hunt, silver's surge from below 50 to over 120 created a volatility shock that now requires multi-stage consolidation. He argues the current 3-wave sell is not random decline, but a structured reset of excessive leverage built during the spike. That framing matters because it suggests weakness is corrective, not terminal. For investors, this is where patience becomes the edge, while volatility resets positioning. Next, Francis Hunt reveals how long-term targets like 333 are derived from decades of cyclical geometry rather than speculation.
So we had to trim this point a little bit. That reduces the second interim a tiny bit. It's up here. So once you were running the 100 level, you were making our second interim. This is the lilac dash line here. And we expect a rest here. That's the nature, and that's the beauty of our structure of setups. It's a trigger when you break here, and then we expect good, fast momentum. Through the interim levels. At the second interim, we expect a rejection, especially on a move of this scale, and you've got it. You had a shooting star, as we've discussed. It's even more of a shooting star in silver than it is in gold, and now you've had much the same again, a pausing, resting. So all the volatility of that sharp move up and the crash down is done. And you're getting this new period, a much calmer version of it. And what ends up happening when it's done respecting this process, we carry on and we run the target. We've done the second interim now. And it's exactly what we expected, which is why we got out. I don't have the wherewithal to hold 47% drawdowns. So we trade within this. We traded long leverage up to this point. We closed leverage. We continue to hold our blue pot. We wait till this is done. And when it resumes upside, we'll resume with leverage longs and we'll close again here. After you've run the 333, there will be another period of pause and gestation before I expect going higher. Remember, the 333 is not our top. We're calling for single-digit gold-silver ratio. So I thought I'd just clarify all of that. And this is This is what you're waiting for. If you don't want to be entertained by the USD Korean won and the markets and how the AI busts, maybe, a short on the Kospi and other things, and you're waiting just for metals.
Markets are often shaped less by direction and more by how institutions manage exposure through volatility cycles. What Francis Hunt is highlighting here is a disciplined separation between leverage exposure and core holdings during high drawdown phases. He notes how interim technical levels act as controlled exit points rather than emotional decisions. That matters because it reveals a professional framework built around risk containment, not prediction certainty. For investors, this reframes volatility as a tool for positioning rather than fear. Next, Francis Hunt exposes why even after major targets like 333 are reached, the cycle is structurally designed to pause before continuation.
That's your show that's coming. But you've got time to sit through because there's still a degree of pause to be experienced here post the second intro.
That's certainly an incredibly exciting picture that you're outlining here for the long term for both silver and gold. How are you thinking about the mining complex currently? When we see this move in silver and gold, will it be a rising tide lift all boats type of event, or is there an opportunity to get granular and selective and potentially pick the best vehicles to ride out this wave?
So just before I leave and go to mining, without the log scale, in case you didn't think that's much of a move, it's going to be the wealth move of the era. The run from 74 to 330. Look at it delogged to appreciate how much of the run we still have to do. And it's going to be a statement on the dollar as much as it's going to be a statement on anything else. Your question on miners, well, it's been interesting because certain miners have actually been okay during this period. You got the one of the ones that we've had an upside HVF up on Aya Gold, looking really good, due to grow quite a lot. It's ounces that it'll mine. There's not very many mines that are actually going to grow ounces. Those are worth watching. It's a smaller market, a smaller mine than some of the others, but looking very good. The oil, obviously, the cost side has been a little bit of a limiter because energy costs have gone up at the same time as revenue went down. So there's been this peculiar substitution. And I do think this has got a lot to do with where we were with potential COMEX failure. Remember, it wasn't that long ago in January, we were getting heating stories as to why the COMEX went down and a whole bunch of trades got resolved. Open interest got resolved. I don't know if you recall that from January. An absolute hocus pocus that was going on.
Commodity cycles don't move evenly across assets. They fracture into winners, laggards, and forced rotations. According to Francis Hunt, the mining sector is not a uniform trade, but a selective leverage play on underlying metal prices. He points out that rising energy costs are compressing margins even as metal prices expand, creating uneven performance across producers. That matters because it breaks the illusion of rising tide lifts all boats narratives often repeated in retail circles. For investors, this means alpha will come from selection, not exposure.